Hello, I'm Nathan Kubik, and thank you for joining us for the fourth quarter of 2017 Carnegie Kubik Capital Markets Outlook. Today, we'll be discussing what we've observed in the financial markets throughout 2017, as well as what we recognize as the most noteworthy influencing factors moving forward in 2018. After a discussion on the potential impacts of those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. The same themes we've been discussing throughout 2017 increased their momentum and carried us through the end of the year. Some areas of focus came to fruition this quarter, with the newly enacted tax reform being the most notable of these events. Throughout this presentation, we will get into some of the market implications of that reform. We will also again focus on the areas of risk and the areas of opportunity. The discussion over and under valuations will once again be addressed, but through a slightly different lens, as there have been some shifts in policies, economics, world dynamics, and even the interest rate environment. Throughout 2017, the financial markets as a whole largely ignored anything that might be considered as negative news. This in part is due to the economy's continued improvement, but also due to the continued overall performance of the actual companies that comprise these markets. Consumer confidence levels continue to grow, and there are a number of items in focus that offer encouragement moving into 2018. We are also seeing fundamentals becoming increasingly important within the markets, and that company execution is tied even more dramatically to that of their stock price. Let's start by reviewing the markets over this past year. 2017 is being heralded as the first ever perfect year for stocks. The terminology perfect year is referring to the stock market's return being positive for every single month of the year. This past month was actually the 14th straight month of positive returns, which is another record. Looking at this chart, we are considering the actual calendar year return as depicted by the gray bars and the intraday or intra-year declines or corrections depicted by the red dots. A correction is a market pullback of over 5%. In fact, before 2017, it had been over 20 years since we've experienced a year without a single 5% correction. On average, there is a 5% correction every 10 weeks, and a 10% correction every 33 weeks, and a 20% correction every 127 weeks. Looking at this chart, we can see that the period of low volatility that we experienced in 2017 is really quite rare. It's important to understand that just because we haven't had a correction in a while, it doesn't mean we're going to have one in the short term. It's also important to understand that we will have one at some point in the future. I should note that at least part of the market's performance in 2017 was due to a strong economic year, with the second and third quarter GDP growth being over 3% and analyst forecasts for the fourth quarter averaging around 3.3%. The economy does appear to be picking up some momentum. Unemployment rates have reached levels that are considered to be as low as you can go. Interest rates are starting to move off their lows, but remain very advantageous for continued growth. And inflation remains well below historical averages. In short, the economy appears to be striding forward. Both consumer sentiment and consumer confidence levels are quite positive and support the belief that the economy will continue to move forward. Given these factors, along with the historically low interest rate environment of bonds, the stock market has continued to climb and has been setting new record highs on a regular basis. As the equity markets have continued to move higher and higher, valuations of the underlying stocks have become an ever-increasing area of focus. In observing this chart, we are considering the historical forward price-to-earnings ratio average compared to that of today's levels. Basically, we are looking at the total value of the S&P 500 divided by its annual earnings. The valuation shown here does imply that the S&P 500 is moderately overvalued compared to that of historical levels. That said, all of those economic factors we just discussed must be taken into account in order to determine whether or not the current valuations make sense. Another way of saying this is, do we believe that the current economy will continue to grow enough for earnings to increase to the level that brings this multiple back to a normative level? The markets clearly believe that to be the case, and one factor that we have not yet discussed is that of tax reform, which has the potential to have a dramatic impact on those valuations in the short term. The corporate tax rate dropped from 35% to 21%. This is a 40% reduction in taxes and has the potential to increase earnings by that entire amount. Of course, many companies will reinvest some of these dollars, but every profitable corporation should have the opportunity to have an immediate benefit to their earnings in 2018 as a result of this tax reform. Even if we ignore the impact of tax reform on corporate earnings, it is important to remember that higher valuations can still be justified if future growth can support those valuations. Historical performance should not be used to predict future events, especially in the short term. That said, these charts can still offer some perspective on valuations and subsequent year returns. Looking at the chart on the left, we can see that historically, when the markets were valued at today's levels, subsequent year returns had a wide disparity, with many of the following years being positive returns. Ultimately, the future earnings of the companies comprising the markets will prove whether or not the current valuation levels are representative of what is to come economically. This chart gives us an indication of the current trend of those companies' earnings. What we're looking at here is a breakdown of where the increase in value came from. Was it simply from the market being willing to pay more for the exact same stocks? Or have the companies grown? Have they increased their earnings? And does that growth demand a higher valuation? The answer is actually both. The blue bar here represents dividends paid. The green bar represents the impact of the increased earnings, and the gray bar represents the increased multiple impact. At the end of the fourth quarter, actual increased earnings accounted for the majority of the equity market's total return. Increased multiples did play a meaningful role, but we believe that that increase can be attributed to expected impacts from tax reform and continued economic expansion. Moving back to tax reform, we've put together a couple of slides that outline what we consider to be the most material changes in the tax code. Please feel free to pause this video if you'd like to spend some more time on this slide, or if you'd like a copy of this or any of the other slides, just let us know and we'll be sure to send those out to you. Regarding corporate tax reform, the biggest change is their tax rate, having been reduced from 35% to 21%. Additionally, many pass-through entities also recognize the major tax cut. And finally, repatriation and the taxation of foreign income has also been addressed. On the individual side of tax reform, there have been some changes as well. As outlined on this slide, there have been some meaningful changes to standard deductions, exemptions, and credits. The tax brackets have changed as well, as shown on the lower portion of this slide. We're looking forward to discussing these items and what they mean for you personally when we're together next. I will note that for most individuals, this tax reform is likely to result in lower taxes and more cash in the individual's hands. And the current level of cash on the sidelines right now is incredibly high. Currently, there is more than $15 trillion sitting in cash. That is more than an entire year of consumer spending in the U.S. and also exceeds the total outstanding mortgage debt. The point here is that there is a significant amount of money that could conceivably enter the financial markets, and if that were to happen, simply looking at supply and demand, security values would likely be pushed higher. The fourth quarter followed the same growth-oriented style trend that we saw throughout all of 2017. Equity markets as a whole continue to move upward, with large cap growth companies capitalizing more effectively than that of value-oriented companies. The large cap growth companies of the S&P 500 realized a 27.4% return, whereas the large cap value companies returned a 15.36%. Moving into 2018, we see no reason to believe this trend is shifting. As we've discussed throughout this outlook, companies that are able to grow their top-line revenue and bottom-line earnings at a greater rate will be most rewarded. Our focus remains on underlying company attributes, financials, and indicators that are likely to result in greater growth rates and with financial strength able to justify current valuations and continued performance in the years to come. For those reasons, our core equity model has remained positioned with an overweight to large cap growth companies. Over the last quarter, we have seen large cap price to earnings ratios relative to their historical average move up by about 3%. This universal move across all the styles of the large cap market implies to us that there is a systematic risk acceptance by the markets. In other words, the markets are willing to accept a slightly higher valuation metric based on the expected growth in the future. An interesting thought is that while growth companies may be better positioned from an earnings growth perspective, value-oriented companies could be considered to be better positioned to benefit from a one-time corporate tax cut, which we believe is already priced in the market. This line of thought explains the fourth quarter price to earnings multiple adjustment and further supports the large cap growth overweight going into 2018. The growth-oriented sectors of technology, consumer discretionaries, and materials led in performance in 2017. Financials, healthcare, and industrials were right there as well, trailing by only 1 or 2%. Every single sector moved up in value in the fourth quarter. This includes traditionally deeper value-oriented sectors of consumer staples, real estate, and utilities, but those sectors did trail the equity market as a whole. In the fourth quarter of 2017, technology, discretionaries, and financials realized the highest returns. In this chart, we look at the weights of the S&P 500 sectors and that of our core equity model. The sector returns at the bottom of the chart are highlighted in an effort to depict which are overweight in green, market weight in yellow, and underweight in red. At the top, you will see our actual current target weights in bold against that of the S&P 500. Moving into 2018, while we still like consumer discretionaries, our core equity model's largest overweights are in technology and financials. As you can see, we continue to have a slight overweight in healthcare, and we had an overweight in materials through most of the third quarter of 2017. The sectors of energy, telecom, utilities, and real estate remain slightly underweight in relation to that of the S&P 500. Here, we look at the current tactical weights of our dividend equity model compared to that of the S&P 500, as well as to our own internal long-term strategic target weights. As we've discussed in the past, this model's focus is on increased stability within the equity markets, which results in a slightly different sector allocation than that of our core model. While the target allocations are different, you will notice similar over and underweights to that of our core model, and technology again is our largest overweight here. The interest rate environment of a flattening yield curve has continued this past quarter. With the short end of the yield curve being pushed upwards by the Federal Reserve raising rates, the long end of the curve actually dropped in the fourth quarter. 2017 was a difficult year in the fixed income markets, and whether or not that will change in 2018 is yet to be seen. That said, there are a few reasons to be encouraged. We are expecting 3 increases of the Fed funds rate in 2018, which will push the short end of the curve higher. Because we believe the risk of an inverted yield curve to be unlikely, we expect these hikes to push the entire curve higher and allow for more attractive bond yields. The economy appears to be gaining momentum, which could also encourage a higher interest rate environment. And international quantitative easing strategies are slowing, which could also lower the demand for our bonds, and this too could offer the opportunity for rates to rise. At this point, this is all simply speculations, as it is too early to say what will truly happen next. There are a number of key global events that certainly have the ability to impact the global interest rate environment as we move through 2018. Some of these countries are already beginning to tip their hands and are offering some transparency into what policy shifts are underway and what might be expected in the months to come. Many of the global central banks have already begun shifting their monetary policies. As we discussed this last quarter, the U.S. is deleveraging its balance sheets. Globally, economies appear to be improving and many countries have begun tightening their policies. Currently, as seen in this chart, the European Central Bank, the Bank of England, and the Bank of Japan are all in the process of tightening their policies. This further supports the themes we've set forth throughout this presentation with a likely expectation of continued economic growth. In conclusion, while we do feel like there are currently risks in each of the financial markets, we do feel cautiously optimistic about where we are economically and where we believe we are headed. Corrections happen, and we should not be surprised when the next correction occurs. While we are always positioned to react should there be a shift within the markets, we believe the U.S. markets continue to be stronger than the rest of the world, and that the items we've discussed today do have the ability to be an economic catalyst, at least in the short term. We are continuing to position our portfolios in efforts to reduce downside risk exposures and with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on any of this information we've presented. Take care, and we look forward to speaking with you soon.